Welcome to the third panel of today, and let me start by thanking Dick and basically for a wonderful morning conference and for this lovely invitation to take part in this event. I think it was a great discussion earlier. The idea for this session is, I guess we're going to shift gears a little bit and talk about tools, talk about stress testing in particular. So, we've heard something about the risks. We've talked a little bit about data gaps as well. So now we're going to kind of turn it to practice. And I've got two of the experts that we could think about, compiling for a panel like this to talk about tools and stress testing for non-banks, especially. So I'll go at the far end to start with. So Nat Benjamin. Nat is the Executive Director for Financial Stability at the Bank of England. He's also a member of the bank's Financial Policy Committee. And Nat, you're going to talk to us, I think, a little bit about the system-wide exploratory scenario that the Bank of England ran about a year ago, or 9 months ago, last year. So this is kind of I think, world-leading innovative effort to try and think about stress testing the non-bank financial system. And then immediately to my adjacent to me, we have Cornelia Holthausen. Cornelia is, I hope I've got your title correct, I should have checked this before, but Director General for Macroprudential Policy and Financial Stability at the European Central Bank. And Cornelia is going to talk to us about the ECB's efforts to integrate non-banks into stress testing tools and frameworks. I hope that's a reasonable description. So we're going to run it in a similar way to the earlier panels. We'll start with some set presentations from both of the panelists. We'll then have a little bit of a discussion amongst ourselves and plenty of time for Q&A from all of you. So Cornelia, you're going to kick us off. Over to you.
Thanks very much. Well, let me wait until the slides have been put up. Can you hear me? Here. It's in my own hands. Okay, so thanks very much. It's really a pleasure to be here. And so I will kick off and start talking about the ECB's efforts to do system-wide stress testing. So just by way of background, within my department, we do have a division that does stress testing. Particularly, we design the scenarios that are then used for the banking stress test. We actually also do scenarios for the insurance and the system and the securities market stress test. And here we have really dedicated quite some effort to develop a system-wide stress test that incorporates several sectors. And I think the whole morning session here today was a great motivation for why we are doing that, because we really see that there are growing interconnections between the bank and the non-bank sector. And contrary to the US, I must say that in Europe, the non-bank financial sector is really still on a growing trend. It's still much smaller than here in the US, but it is growing. So it is more and more in our minds that it's something that we should look at more closely. And in particular, in recent years, we have seen several episodes where we could see that there is really an issue. There are interconnections between the different financial sectors that make us want to look more closely how stress can propagate across the different sectors. And one example is the dash for cash in 2020, and then the LDI crisis that I'm sure Nat will go to talk about a bit later. So as central banks, we want to understand how resilient the system is. That's basically our main motivation. And so at the ECB, we have now started to build a model that allows us to run different scenarios. So it's really a relatively flexible model, and I will go into details in a second. So the sectoral stress tests that we have been doing so far, they are useful. They are in particular useful from a microprudential perspective because they can be used, so the banking stress test can be used to determine the appropriate capital buffers that come out as a result of the stress test. But they are, of course, not sufficient to understand the potential evolution of the system-wide dynamics during a stress. And the system-wide stress test that we have developed, the so-called ISA model, is then able to explore responses of a diverse set of actors across the market. So it allows us to draw macroprudential conclusions, so to really understand what are financial stability implications, and is there to start thinking about whether we have any macroprudential measures that could be used to remedy them. So in the model, we have 3 sectors. So I was very happy when my colleagues were able to add the 3rd sector, but this morning's session made me humble, and because I think there are many, many other smaller sectors that we are not able to model yet, but they're okay. They're probably also smaller than less important than they are in the US. And the first step of our model, we assume that there is some form of exogenous shock. So that could be a market shock. It could be a credit risk shock. So think about COVID, or think about a trade shock, for instance, but it can also be a liquidity shock. So think of a bank run, for instance. Yeah, so anything that shocks any of these type of firms that we have in our model. These firms will then react in some way. So they will have to cope with the shock. They might go into default. They may have to do balance sheet adjustments. Yeah, so this is what I have on this slide. But then what's really where we then go into the system-wide dimension is then the next level. So that's then the endogenous reactions that we see across sectors. And here we model a kind of a pecking order of options for the different firms to recover liquidity, because it's often liquidity that is at the heart of the contagion. And there we are able to model propagation of liquidity stress between the different sectors. And also fire sales is a really important mechanism by which stress can go through the system. So by this model, we can capture both contagion across sectors, but also the amplification. Because then when we have the second round effects, we know that then further defaults can be triggered and further endogenous reactions. So then we kind of can loop it and do it again until we find a kind of a bad state equilibrium. So this is it in a nutshell. Maybe another form of illustrating it. So it's really a network between the different firms in the sector, and of course also within a sector. So you can think there's maybe Fund 1 is not repaying Bank 1, and then Bank 1 may have a credit line to Bank 2, and then Bank 2 is no longer renewing the debt. So there are different ways that then this can really go through the system. I was asked to provide one example. So one recent example where we employed the model is the Fit for 55. So the Fit for 55 is the European Commission's climate package. So basically targeting a reduction in carbon emissions by 55% until 2030. So the Commission asked us to assess the resilience of the financial sector whether they are able to fund this transition and even under stress. So we wanted to gain insights into the capacity of the system to support this transition to the low carbon economy in times of stress. And that required a great deal. So it was really the very first time that we interacted with all the different European players in the system. So the securities regulators, the insurance regulators, to make sure that we had got the data and the dynamics right. And maybe if we start with the left hand chart here, you see what are first round and second round losses. So the dark blue, for instance, are the first round market losses. And then the light blue bars are the second round market losses according to the model that I have just described. So, and I don't want to go too much into detail, but you see also here on the right hand chart. So we are able then to distinguish how large are the losses for the firms in the different sectors, what is first round, what is second round effects. So here we found that actually the system would be quite resilient to even in times of stress. So going forward, what are we planning to do? Here on the right, I list a number of issues that we have already tried to address with the model. So measuring the measurement of financial system interconnectedness has been done, studied by looking at this paper. the Fit for 55 I just explained. We also have some forthcoming publications that study the dynamics of liquidity withdrawals and also something on margin calls and repo markets. So this is ongoing work or soon to be published, but I think more generally the system-wide stress tests are gaining more and more traction among central banks, because we all realize that they are more important. And in particular in the euro area, there's now an effort to establish this, maybe on a more regular basis and or also on a bigger scale. And where Stephen is sitting here, he was on the high level group that was recommending that we actually do this on a more regular basis. And let me stop here.
Maybe just a couple of questions that occurred to me as you were talking. So one is, we had this nice fact in the early morning presentations about, was it 75% of US assets were held by non-banks? Have you got like a rough fact like that, stylus fact for the European financial system, just so people in the audience know roughly how big the non-bank system is?
So I mean, the non-bank sector, as I said, it's growing, but I think it's still like 1/10 of the market here. So it's really not at all in the same dimension, but because it's growing, it's of course a concern for us, and because it's so opaque. So we really still lack data to really understand the market. So we are trying our best to get into that area to understand better.
And for the model itself, so you've got these three sectors. Roughly, like, how granular is it, just so people can understand as well? Are you modeling like individual banks?
Yes.
So how many,
So we have the 130 banks that are in the regular EBA stress test that we do, but we added another roughly 100. So it's more than 200 banks that are in the sample. And we have an enormous amount of funds, and these are it's globally. So anyone who's connected, I think we are talking 10,000 or something. So really a very large number. So this is a huge model with many, many, many equations. So
that's really helpful. Let's go straight to Nat.
Thank you. I mean, actually, on that question, on the proportion of funding to corporates from bank versus non-bank, actually on that chart that Don, you had this morning, the equivalent for the UK is very different. So more than half of the funding to corporates are now provided by market-based finance generally. And actually market-based finance accounts for the vast majority of the increase in that funding over the last decade. So in the UK, it's a very different picture.
No, actually also in the euro area, it's almost 1/2 if you consider that metric. Yeah.
For
corporate funding.
Yeah, funding to corporate. Great, thank you very much. Well, big thanks for having me. It's a pleasure to be with you. So let me tell you a little bit about this system-wide exercise that we ran last year, and we published the results of it at the end of last year. So for us, it was the first time we ran something like this in the UK. First time we ran an exercise focused on stress testing an entire ecosystem rather than individual sector. And the first time we ran an exercise with active engagement from such a wide array of market participants. So it was a bit of a new frontier for us, and we definitely learned a lot from it. And there is no way we would have guessed some of the things we found from the exercise. We could not have discovered them without it. And I think also the market participants in the stress test learned a lot from it, and I'll come back to that. So let me start with, let's see if that, well done, Matt. Works. With the aim of the exercise, which was basically to stress test the resilience of core UK markets. That was the overarching aim. And specifically, when you say core UK markets, we mean the gilt markets, the gilt repo markets, the sterling corporate bond market, and associated interest rate derivatives market. Those that are core to the functioning of the economy, in line with what you were saying, Nelly, earlier about the key role of those markets in the economy. So basically, the idea was indeed to impulse a shock to those markets and see how it plays out, see how it distributes. And in particular, we wanted to test two things. First, we wanted to understand how risks propagate from banks to non-banks and understand the behaviors under stress of those participating in the market and what drove those behaviors. And the second thing we wanted to evaluate as a channel is how those behaviors in turn could amplify the original shock and therefore pose a risk to financial stability. So that was what we wanted to do. Now, why did we want to do that? Why do you want to test that? Well, two main reasons. The first one is, as Cornelia said, we have also a long-standing program of stress tests of different sectors. So we stress test the banks, we stress test the insurers, we regulate the insurers at the Bank of England, and we stress test the CCPs, the clearing houses, separately as sectors. But those sectoral stress tests are not well suited to evaluate the interconnection and the feedback and the blowback across an entire ecosystem. So that wasn't enough to work this out. And second, is that, as we all know too well, and we discussed this morning, the last 5 years or so have been marked by a succession of shocks to those core markets. And shocks that involve non-bank participants that hold either extremely leveraged positions in those core markets or material maturity mismatches. And that also involve banks with very large counterparty concentrations and often larger than they think. So all of those macro system-wide vulnerabilities have been playing out a number of times over the last 5 or so years. What we have seen often is when the shock hits for whatever reason, these weaknesses have shown a tendency to unravel and make it worse, and at times to destabilize those core markets in a way that forced us central banks to intervene, to step in. And indeed, that was the case for the Dash for Cash. There was a case for the LDI episode in the UK in 2022. So the idea of this system-wide exploratory scenario was to learn those lessons and to get ahead of the curve and to test things out in peacetime so that everyone could get prepared for future shocks as and when they could happen. And the big novelty of that exercise were in two areas. First, the focus on an entire ecosystem rather than just one type of market participants. And second, the focus on the behaviors and the reaction functions of the participants. Whereas previously we tended to just assume the reaction function. Well, here we didn't assume, we actually asked them and we played it back to them and we played it back to each other. And so that in a sense, it was a flow test, not a stop test. So that was a big novelty of that exercise. So now let's get to the specific of it. Let's see if I can. Yeah. So the exercise itself. So we, together with the UK's Financial Conduct Authority and the pensions regulator, we convened around 50, north of 50 participants in those core UK markets, ranging from banks, pension funds, insurers, hedge funds, money market funds, open-ended funds, and asset managers, so the whole shooting match. And we're extremely, extremely grateful for all the participation. And one of the best things actually with this exercise was the engagement that we got from all the participants. And I think for most of them, it was a new thing to be involved in, a new exercise to be involved in. And I think part of why we got such good engagement is because we did not set out on this to sort of tell anyone off or to punish anyone or to impose more capital or more liquidity. We just went into this in order to find out what would happen. And it was not just us who wanted to find out what would happen. It was also market participants because they have big positions in those markets. So they also want to understand what would happen because that has a hit to their P&L. So there was a big confluence of interest for different reasons in finding out what would happen under the scenario. And so that collaborative tone of the conversation was perhaps one of the best aspects of actually that exercise. We designed it together with them. We consulted them on the data template. We consulted them on the design of the exercise as a whole, on the multi-round. So it was very much almost a joint endeavor together with the industry. And it was a dynamic stress test in 2 rounds. So the first round, we asked each participant how they would react to a very nasty shock, a very nasty 2-week shock, and what the impact of that would be on their business, on the metrics that they use for their business, their risk metric, their liquidity metrics, and what trades or what actions they would take as a result of the shock. And then in the second round, we gave each participant feedback on the effect of the action of other participants and on the impact of those actions on the core markets themselves. so that we could reset and reinformed how the rest of the story was unfolding in a sense. So that was a key aspect of it. The shock itself was very severe. We stressed some key, you can see that on the chart on the right-hand side, some of the key markets variables such as gilt yields, US Treasury yields, equities, corporate bond spreads, but also some bases that are used in some popular trades. And the combination of all these shocks put together was more severe than anything we've seen in the last 20 years, more severe than LDI, more severe than the dash for cash. So now let's turn to the type of risk transmission channels that we tested across that ecosystem. So here you can see on that chart an illustration of those channels, and in a sense they reflect a number of those vulnerabilities that have been on the international regulatory radar for some time. So we tested how the propagation of margin calls originating from central clearing counterparties and then via banks and onto non-banks, their clients, such as the funds or the insurers, cause liquidity strains for the non-banks. We tested how those calls for liquidity could generate redemptions in money market funds and open-ended funds. And we tested how the action by participants could impact core markets because of either of four things: either asset collateral sales to meet the liquidity needs, or because of changes in the willingness of participants to act as intermediaries in the core markets, or because of deleveraging to reduce losses, or because of hedging activities to keep position hedged after the initial shocks. And in a sense, all four of those reactions had the potential to move the markets. And in turn, that was going to tell us whether the collective actions had the potential to amplify the original shock. So that was the exam question that we set. And now let's turn to what we actually found. So we found that the impact of the shock was a large redistribution of liquidity across the ecosystem. North of 90 billion was redistributed across the system. We found that that redistribution, together with other constraints, caused some non-bank participants to have to recapitalize, deleverage, or de-risk very quickly. And we also found that intermediaries, especially banks, didn't really have appetite for more risk in such scenarios, and that their reaction to demands for extra funding was basically no, whereas some counterparties wrongly assumed that the answer would be yes. And we found that all of that caused some core UK markets to come under pressure. And specifically, even though we saw that the resilience of the gilt market had improved since earlier days, notably reflecting some of the measures that were put in place after the LDI episode, there were some material capacity constraints in the gilt repo market. And also, we found that the sterling corporate bond markets could basically jump to liquidity after some pretty price-insensitive selling pressures and misplaced assumptions on where buyers would actually come in. So now let me turn to what we learned from the exercise. So this is a somewhat artistic attempt to show in a single chart the type of liquidity redistribution that's played out in the exercise that we see over both rounds of the Suez. So on the far left, you can see the total liquidity demand generated by the shock, and that's primarily driven by margin calls. Most of that variation margin calls across both derivatives and cash instruments. And also there's a bit of a redemption, investor redemption, and calls on initial margin. The dotted box at the bottom of the left-hand column shows the degree to which non-banks relied on repo being refinanced by banks. And it also shows, therefore, the extent to which, if that hadn't been forthcoming, where there would have been an even larger need for liquidity. And I'll come back to this. Also, we found, so that's the middle column, that most of the demand was met by pledging securities, primarily gilts and corporate bonds. And and also by redemptions from money markets and open-ended funds to generate cash and additional repo. And on the right-hand side here, you can see that in addition to those liquidity needs, some non-banks acted quickly to deleverage and restore their buffers. And you can think of that and by the liquidation of assets that happened as one of the amplification mechanisms that played out in the shock. Now, it's worth noting that in the exercise, we did see better resilience of the gilt markets than in the past, with the sellers of gilts able to find market participants to buy them, but that really depended on the functioning repo market, and the importance of the functioning of the repo market was really brought home by this exercise. We also saw that banks had the capacity to meet the borrowing requests from their non-bank clients, but what was very clear is that there was generally no willingness to provide additional repo. And a lot of market participants had to revise their assumptions. Well, basically, we told them, you think you're going to get more repo from your banks when you need to think again because they just said you're not going to get any. And that was a very important learning from the exercise. And it does show that even sophisticated market players actually would have less access to financing that they would think they have in those scenarios. You would think they would know. So this was a really important thing for us to feed back to each of the participants so that they could adjust their playbook should a shock like that happen. So specifically, half of the fund managers considered that they had the option, they would have the option to have access to extra repo, and actually a third of them would not have had it. So that just brought home the importance of the gilt repo market in helping to absorb the impact of the shock, and the importance, therefore, of increasing repo market capacity, and initiatives such as clearing are very important in that context, because one of the things banks told us when they did say, well, no more repo for people, often they said, except if the counterparty is cleared. So that illustrates some of the points you were mentioning before, Nelly, about, this is some of the side effects of an initiative like clearing in terms of increasing the potential for liquidity supply if a shock hits. So that's an important learning. We also saw some pro-cyclical behavior on the haircuts side of things. We suspected that would be the case because we knew there's a lot of zero haircuts in a lot of those repo markets, and that did happen indeed. We saw many banks reducing tenors and doubling haircuts over a few days, and putting pressure on other market participants by virtue of doing that. Now, it did not have that much impact to the exercise, but that was purely because at the time when we ran the exercise, hedge funds' use of gilt repo was relatively small. That has changed now. Now the net borrowing, cash borrowing positioning of hedge funds in the repo market is bigger now than it was when actually we had the launch date of the exercise. So some of those things evolve. And so I'll come back to the importance of us, keeping track of the answer to the same exam question over time. So that is some of the huge value in those exercises, which is just simply showing the facts and illustrating the risks. And which is something we'll have to do more and more, especially in the sort of a jittery and turbulent environment we're in. And so finally, so this is just a bit of a high-level summary of the findings and the conclusions from the exercise, and it's difficult to do justice to it, but in a nutshell, that's in that table. So clearly, in terms of system-wide amplification, the SWAYs really provided a very rich evidence base on how actions in the non-bank sector can amplify shocks. That is definitely the case. We also saw that despite having a sample of very sophisticated firms, actually there were instances where they could not anticipate the behavior of counterparties or investors or markets under stress. And the repo example was a key one, but also we saw on the open-ended funds and money market funds, actually, they also struggled to anticipate the degree of requests for redemptions that was actually going to be forthcoming. One thing we try to do through the exercise is to be maximalist in how much information we shared back to some of the market participants. And we alluded to that earlier in terms of the importance of data and data sharing, and to help market players understand where they stand in the aggregate picture, so that they can use that knowledge and that understanding to adjust their playbooks and their risk management. And we saw a big benefits from that, from the exercise, and we've got positive feedback from that, from the participant, the market participants. So I think that is a very promising theme. You know, in a world where we wonder about data and sharing information, it's important, once we absorb information as an authority, to share it back, both in aggregates and to individual participants. The second conclusion is that it is the case that non-bank resilience is higher than it was in the past, in particular with LDI funds who held bigger buffers. Money market funds also had greater liquidity buffers, but it's clear that although some of that resilience is locked in, a lot of it isn't locked in. So that can change, that picture can change quite quickly. So it's very important that initiatives such as the one on the menu list of the Financial Stability Board are pursued, because they really push where it hurts in terms of those vulnerabilities. The exercise did underline the importance and the centrality of the repo market, and here we talked about the type of measures that can foster that, and its importance to support core functioning. The finding on funds and their sensitivity to investor demands in the Suez led to some, as I said, price-insensitive selling, and basically we found that the sterling corporate bond market would seize up, would jump to illiquidity under that scenario, which is not something we would have suspected without having done that exercise. So learning the lessons from that is important. The pensions regulator in the UK is following that up with pension funds in the UK, but also notions like thinking about sterling corporate bonds as collateral in terms of eligibility for secured lending is another thing that needs to be considered in terms of the so what from the findings. Finally, I would say that those type of exercises have proved to be a really powerful tool to understand the system level vulnerabilities. And there's two things we want to do on the back of that. One, it's proved a very efficient way of chartering the land, if we think as a cartographer in a sense of vulnerabilities. So in the future, when there are other aspects of the ecosystem which are opaque, where there's many participants and it's not clear how the interconnections play out, that would be a great tool for that. But also, it is possible to use this exercise to keep track of the answer to the same exam question, but in a much less burdensome way, both for us and for market participants, because you can use everything we learned to inform some form of data modeling, so that we don't need to rerun such a big exercise every time. So that's another thing we want to be able to do, is to leverage what we have learned from this particular exercise for the future. Let me pause here.
Great, thank you. So maybe a couple of little clarifying questions for you as well. What do you assume about the central bank in all this?
So we assume that our standing facilities are still open for business, as they are all the time, but we've told participants that they should not assume any special central bank intervention as a result of the shock.
And that includes, so the Bank of England has this non-bank facility that you've...
So we just launched, we just operationalized, for people who don't know what we called, we created a new acronym. It's called CNRF, the Contingent Non-Bank Repo Facility, which for the first time would, if we decide to activate it, because if we decide that market circumstances justify it, would enable us to lend directly to certain types of non-banks like insurers and pension funds. So the assumption is that this was not switched on, that we would not do that.
And the second question I have is, you emphasized a lot learning about the behavior of agents through the test. Now, I guess like one difficulty for me is you've got this 2-week stress scenario. I'd imagine the behavior of a hedge fund, say, or a bank is going to be very different depending on what they think is happening after that 2-week scenario. So if they think the world is going to return to kind of rosiness at the end of two weeks, maybe you kind of see it through, whereas if it's, you know, things continue to slide after then. So what was the kind of assumption given to agents beyond the 2-week horizon?
I think the assumption was just so it's not a return to normal, basically, but a shock, and then the macroeconomic consequences of the shock, in a sense. But we didn't set out any sort of a type of intervention from the authorities, either central bank or other authorities, to respond to the shock. But we just saying, at the end of the 2 weeks, this is the state of the world.
So it's continuing uncertainty.
That's right.
In some sense. Great.
And we were just in line with that question. We were pretty agnostic to what was the trigger for the original shock, a bit like Cornelia described in her exercise. We say, something triggered the shock, and then those are the channels that played out.
Yeah, I see. So I've got a couple of questions for both of you, and then we'll take some questions from the floor if you want to kind of store your ideas. So maybe Cornelia, to start with, I think this question about transmission channels and shocks is quite interesting. One difference between these two exercises, in case it wasn't clear, is one of them is a top-down modelling exercise, effectively. That's the ECB's work. And the Bank of England's work is a bottom-up exercise involving feedback from firms. Now, one big benefit of your kind of laboratory that you've built effectively is you can test different scenarios and shocks and transmission channels. So is there something you've learned about, what types of shocks are especially dangerous for the non-bank system, or alternatively, the channels that you think are kind of most interesting that you want to kind of emphasize?
No, sure. No, exactly. Because so we don't have these results, these immediate results that Ned just presented, because it really depends on which type of scenario you run using the model. And of course, it depends on the severity that you input in the beginning. So it's hard to say whether, what is the shock that has most impact on the system. What we do see is that if we look at liquidity stress is really strongest when we see that there's a widespread redemption, fund redemptions. So if that is the case, then we see that we get the most adverse effects, basically, that then also drives further deposit withdrawals and further fire sales. And if you look at the overall impact, so the overall losses, it's the fire sales. So once you are in a situation when you have fire sales, which is an extreme situation to be in, but once you're there, then we have the largest losses.
That's it. And how about one of the themes of the morning's discussion was the link between banks and non-banks. We had these three, I forget who said this in the presentation, there were three kind of stories for how this relationship would work. And one of them was around, it seems in the data, a lot of banks are funding non-banks. That's the kind of, that's how disintermediation has worked. It's basically banks funding non-banks. Is that also a feature in Europe? And have you embedded that within your model?
Yeah, we have, and you can see that. And so you do see that several sectors and the firms there, and they have similar investment also. And then plus then you have insurances that are invested in funds. So it all goes, it moves in at the same time. So we do see this is a major element of the contagion. Yeah.
Okay. And maybe Nat, similar questions for you, really.
It's definitely the case that banks are by far the major providers of leverage to non-banks. And by the way, it's the same for the private market ecosystem. Absolutely the same.
Yeah. And I guess you can't look at this question about which shock is most damaging. Is there anything you could do with your results to unpick, what aspect led to the biggest kind of impact?
And in a sense, all the three systemic vulnerabilities, so maturity mismatch, excessive leverage, extreme leverage, and concentration, they all played out in different ways. So it's difficult to disentangle which one is strongest. They are interlinked in a sense. One thing that is quite important, and I think that'll be important for us to try and get our head around just generally in the future, is who is warehousing risk, on whose balance sheet is it sitting, and the fact that a lot relies on banks warehousing certain risk, and hedge funds also have been warehousing certain risk, but a lot relies on decision to accept to be warehousing certain risk for a certain amount of time. And I think that as we think in the future about system-wide stresses, understanding who warehouses that risk is going to be quite important.
Let's take some questions. So I've got a couple of hands here. start in this corner, and then we'll start with Steve and then work our way up.
I'm not sure I should be before Rob. Thanks for this. I think you probably both know I'm an incredibly big supporter of system-wide stress tests, and I think it's really what we need to be thinking about in terms of sort of going to the next stage of our macroprudential policy. It's really interesting to hear you talk about these, and they're very, very different. And I had one question for each of you about the methods that you're using. So I thought about stress tests always of the traditional type, well, let's say, of basically thinking of each institution being on an island, hitting it, not letting anything come in and out, and making sure that everyone can stand on their own. And when they can stand on their own, then that means that everything can stand on its own. So the ECB's version of this is relatively mechanical. And so the question there is, how should I think about the process that you're using to figure out what I would call the elasticities or the spillovers that you're getting? So that's one question. The question for the Bank of England one is, so this is a caricature of economists that I learned when I was young, and that is, don't ask people what they're going to do, look at what they do. Asking them, they don't know answers to questions. It's about revealed preference. Don't ask them. So my question for you, since you asked them, is about strategic answers. And how I should think about what the strategic behavior is of the agents, not in the reality, but in your simulated test. And why is it that, because I'm sure you've thought about this, why should I believe them? Thanks.
Yeah, maybe or you want to take several at this time? No, so I'm not one of the modelers, no, but I think it's a mix of looking at the results what we get from the sectoral stress test. It is using the models that are floating around, academic models, so trying to understand the basic relationships, and also the experience that we have seen. We have observed now a number of crisis situations, so we see what were the main channels there. So we try to input all of that in our modeling framework. Now that's of course crucial, now that we get it right, and of course it's maybe not be forward looking. We don't know what the next crisis, how it's going to play out, and maybe that channels that we don't have in here. No, so I think these type of models, they have to evolve continuously. Not only, so actually the beauty of this model is that you can add new elements. So you can extend it and focus on some areas where you think that contagion is particularly relevant. And then I think we can also, going forward, learn from things like the Swiss. So I think actually these two approaches, they can really feed each other, no? Because we hear from you where you find maybe surprising results that are not yet there in the model, and we can try to figure out an equation that captures that. And I suppose that you can then also see from our type of models where we see huge impact, and actually test whether what they have said makes any sense.
And that, just on that point, that's one of the things we're now investing in, is to do a depth-based replication. Is it me? A depth-based replication of the swears, so that we use the exercise to directly calibrate the type of models that Cornelia and others have, and so that we can replicate the thing on a much less burdensome way. For example, to your question of believing or trust and verify, let's do it that way. That's the beauty of the two-round setup, because we get, people tell us what they think they would do, whether it's strategic or not, and then we can use what we know actually happened in past shocks to kick tires. And that's part of the things we did at the end of the first round. We said, are you sure that this is what happened? And we could challenge those statements, both from what the counterparties were telling us, because counterparties have also an incentive to get those tires kicked, and from what we observed in previous shocks. And sometimes we just said, well, we are going to assume that instead that is happening. So markets are moving that way. So, this becomes the scenario. So we use that two-round structure to kick those tires.
You had a question, bro.
Actually, I suppose I'd like to think of it as a follow-on to both of your questions. And Cornelia, if you're taking parameters from academic literature, how do they figure out the causality? Because we talked this morning about how banks and non-banks are equally, they're all interrelated, and the banks cause stress to the non-banks, and the non-banks cause stress to the banks, and you can ask them about it, but when you actually estimate these models, it's pretty hard to separate the directions of causality. Mostly what you see is contemporaneous movements, and so I think you're thinking that you're getting at causality, but maybe it's hard to tell from these kinds of studies whether you've actually got it the right way. And I was going to ask you kind of the same question, but in the experimental literature, which I don't know very well, it makes a big difference whether people get paid or not. If they're actually rewarded for being effective, they actually try harder. And I wondered whether you'd probably have to give pretty substantial reward to a hedge fund manager to get him to really take this game seriously. But have you?
I mean, I think, if I may, on that, I think that's part of the what was good is that because there was no punishment as a result of the exercise based on the findings, it was literally to enable everyone, including, I mean, we talk about hedge funds, but any other participants, we gave them the feedback from what their counterparties said they would do and how they stand in comparison to their peers and the rest of the market. That is very valuable information for them. It helps them a lot because otherwise, I mean, they take big P&L hits as a result of that, not knowing that information. So that's the reward they get as a result. And I think that's probably in part why we had some positive engagements from them.
And on the causality, I mean, I guess it depends on how you model the initial shock. So if the initial shock is one, I don't know, there's a physical risk, there's materialization in the climate world, then maybe the insurances are the ones who are hit first, and then from there it trickles down to the other sectors. But if you think of a bank failure, it's different. Also, but I take your point, and I could imagine, but I don't know that also, you can make choices on which channels you actually want to include in the model. Maybe sometimes it doesn't make sense and you leave out a certain correlation. Yeah.
Okay. Question there.
I had a much more unfair question, if I may. Treasury Secretary John Connolly once said, "The dollar is our currency, but your problem." And in recent stress events, we've had central bank swap lines to make sure US dollar liquidity is available in other countries. Do you have any intuition if the US takes a more autarkic approach or a less cooperative approach in the world? What happens if central bank swap lines don't exist in the same way going forward? What would be the stress implications of something like that if the role of dollar funding offshore institutions became interrupted, and what might be some of the feedbacks to look out for?
So look, I mean, I know there's been lots of talk about these things. I mean, what I can say is that swap line is an essential part of the backstop of the global system, and there's been no change to the to the setup and to the engagement we've had on that front.
Let's leave it here.
Good question. In front.
The good news is can you hear me? The good news is my first question was Steve's question, which was answered. But my second question, a little bit more detail on, did you get any insight, Nat, into the reason why the banks were not extending the repo lines? Is it a limit? Was there any counterparty specific risk assessment done?
Yeah.
Was it supply? They didn't have the capacity, capital capacity. And did they have a sense of the P&L or capital depletion implications of the exercise?
So yes, we did have a sense of that because we explored that. We discussed that quite a lot with the banks, and basically it was commercial decisions. Risk appetite for lower rated counterparties they thought would be weaker, more vulnerable under the scenario. And basically when these moments come, as you well know, people say, no more to these ones. We don't want to be the counterparties don't know that. Exactly right. So we do not want to be the last one standing. So it's commercial. It's not a capacity constraint. It's more a commercial decision. No, we don't go any further on that front, except if they are cleared.
No?
Hi, maybe both of you could speak to this. You had insurance companies and you had funds as key sectors at Nonbank. Can you give us some idea of how much of the liquidity stresses came from the respective sectors? Like how much of it came from insurance companies? I think that's a question that, at least in the US has been a big, issue.
Yeah, for me, it's hard to say because it depends on the scenario that you look at, no? So I don't know. I mean,
So there
Yeah.
are scenarios in which insurance companies stress the system as much as private ones.
Are they important? I suppose.
I think they're important. I mean, I think this morning showed really that they are really important, no? Because so many of you talked about them and the interlinkages with private equity, for instance, which I think is growing a lot everywhere. So, but I couldn't put any numbers on that. But it's certainly something that we should look at more carefully.
And for us, it's a definite yes. Insurance companies and pension funds were a very important part of those stresses that we saw. So, for example, I mentioned the corporate bonds markets seizing up under the shock, jumping to liquidity. A lot of that was driven by the way in which some of the pension funds had to find that liquidity and rebuild some of the buffer. So the answer is yes, definitely.
Roger at the top.
Thank you. This is, both of you are doing a very ambitious project. And my question is a little bit along the lines of what David asked about resolution, cross-sectional resolution, essentially our granularity. When there's a shock in the markets, things move real fast. So I want to know a little bit more about the time scale or resolution at which this is done. So I think, Nat, the way you were describing it was a 2-week problem. And was that also the time scale at which you measured the health of the patient, so to speak? And Cornelia, I didn't quite I wasn't quite able to figure out from your discussion what the time scale was. If you use, if part of what you use is the banking stress test machinery, I believe those are at annual resolution. And is that the case what you did? And that's probably very coarse. What can you still learn if it is in fact annual? If it's not, what was it?
So the answer is yes. It was a 2-week shock, and that's the time window that we used to evaluate the impact of the shock. Remember, this was a stress test of the markets. It was not supposed to be a stress test of market participants. And in a sense, if some market participants go to the wall in that shock, if it doesn't impact the market, it's their problem. Our focus is the core markets. Now, clearly, if some of them go to the wall and impact the markets by doing so, then that's our problem also. But that's an important distinction in terms of why we do the exercise. Now, having said that, what we haven't done yet, and this is the sort of a joining of dots that we want to do in the future, is to link those type of system-wide exercises to the other exercises that test the resilience of market participants, like banks, like insurers, and like clearinghouses. That we haven't done yet, but is the next frontier for us, is to, and a bit to your question, Rob, is to draw the links between those different exercises that have one inform the other.
So I cannot give you an answer now, what is exactly the time horizon that we are looking at here, but I think, understand the gist of your question. So if you have a liquidity problem, that's going to unravel really fast, no? So if you think about a 1-year horizon, maybe it doesn't make so much sense, because by then a lot different things will have happened. In particular, you will have had a lot of interaction by central banks and so on. So I think this is an issue for the liquidity stress test, that we really get the timing right. And I think we're still working on this. Yeah.
Okay, we're nearly out of time, so maybe I just want to give you each a final word on like where you think this stuff is heading. So, you know, what's next on your agendas? This is, as you said, it's a very ambitious agenda, and it's great you've kind of shared these kind of initial results with us. So, yeah, what for each of you, where are you heading with this work?
So maybe I start. So first of all, it's adding more sectors. So I think the CCPs is one element that we colleagues would like to add then. And then there's a data issue. So it's really hard to have the right data here. And I think, Dick, you said it earlier, no? We have lots of data available in the regulatory authorities, but we have issues with sharing them. There are legal constraints very often, and there are also different metrics that are being used. So it's really hard to piece them all together to make sure that they speak to each other, or that they measure the same thing, and that to ensure that we don't have any gaps. So that's something we are working on and trying to solve. By the way, also on the international front, no, the FSB is now doing a lot on this data sharing in relation to, you know, leverage margins and so on. So in all of that work, that I hope will get some traction, and that's a key recommendation that we also have in the forthcoming paper on leverage and non-banks. So that's, for us, I think, is really key, and also to ensure that we have the right type of granularity in the data, because right now in our stresses we still depend on a mix of information that is collected by the authorities directly from the firms affected, but then we rely on like Lipper data. So because we don't have a better data source, so that would enable us to really take a big step further.
Can I just comment on that?
Yeah,
sure.
And I don't know if you can hear me, but it's exactly 10 years ago that Andy Haldane at the Bank of England and Arl Schubert and I, Arl was the chief data officer at the ECB at the time, we did a series of workshops on setting global standards for granular data. And there was an op-ed in the FT that appeared at the time by the three of us. There still is a lot of work to do, as you indicate, and maybe it's time for a second round of that kind of symposium.
Thank you, Dave.
And I would say next step is definitely investing in system-wide exercises, both in terms of keeping tab on, you know, tracking how the answer to this exam question evolves over time as positions evolve, but also chartering new lands, exploring new ecosystems where there's a lot of opacity. Second, joining the dots between different types of stress tests to get one to learn from the other. And third, this point that Cornelia was mentioning, to use those exercises to show the facts. There was a lot in the aftermath of the global financial crisis. There were, questions by authorities about, oh, but we didn't know that this would be that the impact of deregulation would be those risks. We haven't been told. There is a role to actually use all these exercises, say, well, those are the risks, those are the facts. And both through the work of the Financial Stability Board and the work of the authorities, there is a role in actually showing the facts and showing the risks and how they can play out. And those exercises are very powerful ways of achieving just that, in terms of telling everyone how bad things could be, and also helping market participants be better prepared for them.
Great. We're out of time, so let's stop there. Thank you very much.
Yep.